directors of small companies have to be willing to roll up their sleeves and really get to work to make sure that the information that they need is there when they need it.
Good evening, everyone. Welcome back to Entrepreneurship 101 and our lecture on boards and governance. It's good to have you all here, and good to have David Litwiller, who is entrepreneur in residence at Communitech and our guest speaker this evening. Before I introduce David properly, a few announcements. If you have not had your card stamp stamped, please do so before 6:15. As usual, we close the registration desk at that time. Shout out to our webcast participants from NORCAT, Innovation Factory, and Haltech. As usual, very good to have you joining us. A few more announcements. If you were not here last week, you missed something very exciting. We were very happy to announce that KPMG is sponsoring the 2014 Upstart Competition cash prize of $15,000, which is a very big deal for us. If you are not very familiar with the Upstart competition, the cash prize was $10,000 last year, and this year it's $15,000. And KPMG has been working with us for quite some time. Now they're digging their heels in just a bit more and doing some work with our startups. More specifically, and with the Upstart competition. So we're very glad to have them continuing to work with us. Next week, there won't be any Entrepreneurship 101. We go on a brief hiatus, so don't show up next week, Wednesday. It's always good to have you here, but it's a good opportunity to catch up on any lectures that you might have missed. We do record all our lectures, so everything is on the website. To introduce David Litwiller serves as director and advisor to a number of early and growth stage technology companies in the Waterloo region, including through his role with Communitech. And to give you a bit of background on Communitech itself, it's one of 17 regional innovation centers in Ontario, and so is a member of the Ontario Network of Excellence, and by virtue of that is a partner with Mars and the other 15 innovation centers in the region in promoting, developing, and supporting the growth of technology-based companies in the region. They're a really vibrant community. It's been a pleasure of ours to be able to work with them in the mission of pushing innovation in the region. And they have 2 locations in the province, so if you're ever in the Waterloo region, ever have a chance to go to Waterloo to visit that location, then by all means, drop in and tell them hi. Back to David's introduction after that quick context. So in 2011, since 2011, David has been an executive in residence with Communitech and a private consultant to emerging technology businesses. He advises on matters of strategy, finance, function, general management, and governance. From 2008 to 2010, David has served as the Chief Operating Officer of an enterprise software developer in the digital marketing and clinical messaging sector, where he oversaw development, quality assurance, product management, HR, finance, accounting, and the board of directors. Prior to that, he was with a semiconductor and electro-optic instrumentation producer, where he worked in a variety of staff and executive positions. We're very glad to have him here. I've heard wonderful things about him. Please join me in welcoming him to the stage.
Good evening, everyone, and Gina, thank you very much for that kind introduction. So we're here to talk about governance this evening, and it's good to see that Rob Ford and his entourage are in the front row. No. All right. So we are going to talk for the next hour or so about the practical issues and some of the landscape issues that affect the governance of early stage companies. It's a different matter than the governance of larger companies, much of which is what you read about in the papers, particularly when things go poorly. And the practice of being a director or for interacting with the board as the CEO or as the founder of a company has a lot of significant differences when in a small company setting, in a high growth setting. And so we'll make that the focus of what we're going to talk about this evening. The one thing that I should preface the discussion with is a lot of the matters related to governance do have a fair bit of legal significance to them. So don't treat tonight's discussion as the last word on governance. Treat this as an introduction to what the significant topics are, so that as you start to approach issues that appear to have that character, that you understand that that is an area that likely has significant legal ramifications, and at the appropriate time, you will want to get the right advice, particularly legal advice, when dealing with these matters. The main parts of the talk this evening, it'll be 5 segments. We're going to start off by a basic comparison and contrasting of the board of directors versus a board of advisors, sometimes alternately referred to as the fiduciary board versus just an advisory board. We will then talk about what the specific roles and responsibilities of directors are. Then we'll talk about how to build, manage, and evaluate the board of directors. Then we'll move to how to evolve the governance of a company to keep up with and in fact lead the growth and evolution of the business itself. And finally, we'll finish off with just a quick comment on director compensation. And the reason I put that in is that if I leave that out, that's always the first question that I get when the talk is done. So I figured out I will just throw a slide in to directly tackle that issue. As you heard briefly in the introduction, my background is general management of technology companies on the whole. And what I do today is split my time between being a professional director of a number of early and growth stage companies, as well as advising in less formal roles a number of other companies. So right to it, talking about what is the board of directors versus what is the board of advisors, and how should you think about those two? And sometimes people use those terms interchangeably, and they're not, and it's important to understand the distinction. And so I'm going to move from top to bottom, talking about what is the board of directors, and then I'll run through the same criteria for the board of advisors. When it comes to the directors of the corporation, the board of directors, they are selected by the shareholders. Their purpose is to oversee the business affairs of the corporation, and they have significant obligations under both statutory and case law. Some of the leading examples of the statutory law are the Canadian Business Corporations Act, the Ontario Business Corporations Act, the Business Insolvency Act, the Employment Standards Act, as well as others. But at various points in statutory law plus additional case law, there are many responsibilities that are imposed upon directors. Moving on to agenda for meetings. In the case of the board of directors, they set their own agenda. They do have power to hire and fire. First and foremost, they hire and fire the CEO. They also appoint the other officers of the corporation. For directors personally, there is liability in being a director, meaning that they can be personally held responsible for certain liabilities incurred by the business. So it's not a role to be taken lightly by them or by you in your relationship as entrepreneur with your board. There are 2 cardinal duties that the directors have, and we will talk at length in a couple of slides about these, but one is their fiduciary duty and the other is their duty of care. In the case of the board of directors, there is compulsory business information that has to be disclosed to the board in order that they be able to deliberate and to weigh in appropriately on the affairs of the corporation. And in practice, to do the job well, being a director means at least 100 hours a year as a minimum starting point. And in practice, With dynamic, growing technology companies, I would say that it's at least a 250-hour-a-year commitment, and it goes up from there if you're on committees as the company is getting larger, such as the audit committee, and it goes higher again if you're actually chairing the board of directors. This is not an insignificant time commitment relative to a 2,000-hour work year to be a director and do the job well. So that gives you a number of dimensions of ways to think about what is the board of directors. Now, I'll contrast that to a non-fiduciary board of advisors. And some people have very formally constituted advisory boards with named advisors that are on the website, and they meet at a regular cadence, and there's compensation. And it ranges right down to people you just meet as entrepreneurs from time to time over a coffee, whose point of view or experience you find to be particularly helpful for your business. In the case of advisors, they are appointed by management, they work for management, and they just advise as requested on matters as narrow or as broad as management would care to seek their input. They have no obligations under statutory or case law as long as they don't blur into becoming de facto directors of the corporation. The agenda of what advisors talk about is set by management. The advisors have no power to hire or fire. They have little liability. Their duties are strictly at the convenience of management, and an entrepreneur or a management team only needs to disclose as much business information to the advisors as the entrepreneur cares to. And overall, that means that the time commitment can be very flexible. It can be everything from a few hours a quarter to something much more engaged, but it's quite flexible, and it can be arranged to suit the needs of both parties. So now we'll talk about the two main duties of directors that I foreshadowed a few minutes ago. The first is the duty of loyalty, alternately referred to as the fiduciary duty. This is the duty to act honestly in good faith with a view to the best interests of the corporation. And part of that is that it means that they have to give unqualified priority to the corporation over all other interests that they may have. And to make that meaningful, let me give you an example. It doesn't matter whether a director is a founder of the company, an employee of the company, is an investor in the company, or is an independently appointed director to the company. Once they're on the board, their responsibility is to the best interests of the company, not whatever relationships got them to the board in the first place. There's a tangible example of what that means. Once you're on the board, it's all about what's in the best interest of the company. Furthermore, as part of the duty of loyalty, the directors have to act in an open and honest fashion. They have to disclose all significant information within the individual director's knowledge that's pertinent to the well-being of the corporation. They need to maintain confidentiality of the corporation's information. They need to exercise independent judgment. They can't just go along with the herd mentality of what the board as a group seem to be leaning towards. There has to be individual deliberation and accountability to fulfill the duty of loyalty. And the final point is, once the board discussion is done and the board meeting is closed, the board needs to act with one voice outside of the boardroom. The second duty of directors in Canada is the duty of care. And this is to exercise the care, diligence, and skill that a reasonably prudent person would exercise in comparable circumstances. And what that means, to break that down further, is that they're acting in good faith, they're acting rationally, reasonably, and on an informed basis. And they are identifying and acting on the problems which should have been apparent to reasonably informed and active people in the same circumstance. and that they follow reasonable processes and practices. So that in total is the two main duties of directors in Canada. So it's important to think about even at that level before we get into anything further. When you're considering establishing a board, growing a board, evolving a board, you always start with the bedrock of those two duties and saying, do I have the people, or are the people that I'm looking at the kind of people that I believe can fulfill those roles or those duties? And if you do, you have a strong basis to move forward. And if you don't, frankly, you're looking at the wrong people or thinking about the wrong arrangement, maybe with the right people. There's a further obligation. Now, in the US, this is elevated to, in fact, a full duty of directors. There's a third duty in the US. It doesn't quite have that elevated status, but because sometimes it can appear to be at odds with some of the other duties, it's worth mentioning explicitly, which is the directors do have the obligation to inform and advise shareholders of all material information relating to matters for which shareholder action is sought. So even though a director is under an obligation of confidentiality and of speaking with one voice outside of the boardroom, there's a simultaneous obligation, especially when going to shareholders seeking their action for something, that there be sufficient disclosure for the shareholders to be able to make that decision. Now, the standard of performance by which directors are held, and this also is the protection and the defense for being a director, for how and why decisions were made at the time that they were made, is to give due diligence to matters that are under consideration, meaning that the directors access the information that they should have access to be able to contemplate the decision that was under review, that they followed a deliberative process where the directors were not sufficiently expert themselves, that they then engaged appropriate experts or independent authorities, and to record the proceedings of the board's workings, meaning the minutes of the meeting and minuting the decisions that were taken. As well, there's something called the business judgment rule, which means that that directors in general will be in good standing even if a decision turns out to have not worked very well. And that's always a risk in a fast-changing dynamic environment. But that the directors will have fulfilled their duties if they were acting in a manner which at the time the decision was made that they believed was reasonably in the best interest of the corporation, and that they were also fulfilling their other duties, such as information access and proper deliberation and things like that. So there's a lot of value to the process by which the board of directors acts and operates, because it's really the process through which they work that is one of the main ways of ensuring that business judgment and due diligence are met, and that the standard of performance that the shareholders and stakeholders in the corporation are entitled to expect from the board of directors is being delivered. Now, let me switch gears now from that more formal kind of legalese sort of stuff, and we're going to get now into more practical day-to-day issues of having a high-performing board of directors in an early-stage company. The leading issues that the board is dealing with is first off, they need to mentor the CEO. The board is responsible for the CEO's performance and that of executive management as a whole. So first and foremost, they need to support and appraise the CEO most of the time. And candidly, in extreme cases, if necessary, they need to remove and replace the CEO. Second responsibility is in a young technology company is typically to make sure that the business does not run out of cash. The third one, I think, will come as no surprise, deliberating major strategic shifts for the business. The fourth is selling the company and building buyer value, but I don't just mean selling the company outright when it comes time for a liquidity event. I mean also just partial sales of the business during the next round of financing or situations like that. But the board needs to be keenly aware of not just what's building shareholder value, but thinking even more specifically about what's building buyer value over the runway that we're looking at before we next need to raise funds. And then the final practical issue that's top of mind for me is shareholder communication. Thinking about what is the frequency with which we're going to communicate with shareholders, to what how elaborate are these communications going to be. But it's very important that the board be talking about those things as an ongoing practice so that there isn't a disjointed or inefficient reaction in advance of the annual meeting or some other singular event or annual event that makes the board realize that its shareholder communication work has not been keeping up to speed for quite some time. That needs to be part of the board dialogue regularly. Now, in terms of, as being the CEO, what you're looking for to qualify good directors or good candidate directors, these are people who indicate important questions to the CEO and the chair of the board, if they're separate people, in advance of the board meetings. So these are not people who are reactive and wait for the meeting to all of a sudden surface big issues that have been nagging at them for a while. Or pivotal questions that they've realized because of things that they've learned recently. These are people who get in front of those issues and are talking about those things in advance of the formal board meetings so that everybody has as much time as possible to think constructively about those issues, do some research if necessary, deliberate, or at least have a range of options in mind. These are people, and especially in earlier stage businesses, who don't always demand more data to make a decision. Now, sometimes, even in a young company, the best thing you can do as a director is say, as much as we're pressed for time, we really need and can get better data to make a much better decision in a fairly short period of time. But in other cases, it simply is an uncertain business. And it's about having a risk profile, a risk appetite of directors that largely matches what the stage of development for the business overall is. So you need to have people who at times can make decisions without needing a whole lot of more data, but also people who sometimes know when to tap the brakes and say, we need more. And people who don't gang up on the CEO. Sometimes there can be a little bit of a herd mentality in a boardroom, especially as you start getting into larger boards, 5 people, 7 people, or beyond. And you want people for a variety of reasons, some of which even link back to the basic duties of directors, but you need people who can be independent of thought, even in a group setting, and have the confidence to be able to do that. But one of the manifestations specifically for this relationship between the director and the CEO is that these aren't people that tend to gang up frequently on the CEO, and they're happy to deal with their concerns more individually most of the time. So a couple of or more than a couple, a few points of sober reality about boards of directors and the operation of a board, and this is equally applicable whether you're on the management or founder side or whether you're on the director side. It's work. People need to be work-like about it. This is not an invitation to the country club or some nice perk. It can be a little bit of a perk, but it's a lot of work, and as a director, you have to be out earning that every month that you're working with a young company. The liability is significant. One of the protections that most good directors will seek is that the company have company-provided directors and officers insurance. The board needs to be collectively knowledgeable about all of the salient aspects of the business and the broader context. even though individual directors' skills can be more narrow. You're not looking for every director to be an omniscient being that understands every aspect of the business, but you do need to think about matching up the different skill areas of your directors with the overall needs of the business to make sure that the major bases are covered. All directors need to be engaged, they need to be active contributors, and they need to be documented as such. Directors who are staying silent for too long on too many issues, they are not just letting themselves down, they are letting the entire board and the company down. So back to that theme of confident individualism, while still being able to work in a team, directors need to be individually engaged at all times. I've already talked about the risk tolerance needs to match the stage of growth of the business. If you take a super conservative person as a director and put them in a very dynamic, risky young company, that's a bad mix. You need people who really get and can work with the risk profile of the business in the way that it needs to move to succeed in its environment at its stage of growth. And directors need to be prepared to really roll up their sleeves and do a lot of work. There is typically little to no management or staff support for the board in small companies. This is not like big companies who have dedicated people who do nothing but support the board and their needs for information. So the directors of small companies have to be willing to roll up their sleeves and really get to work to make sure that the information that they need is there when they need it. Next, we'll talk about evolving the board as time goes on, as the company grows and matures, and as competitive conditions develop. One of the things that needs to be able to change with some flexibility is who's on the board. The same person who was a rock star director when the company was just getting off the launch pad and raising its first couple rounds of financing may not be the person who is right when things need to get necessarily more controlled, more deliberate. Maybe the liabilities for the business are getting larger as its customer base or stakeholder base is getting larger. So you want to make sure first and foremost that you have a mechanism to be able to renew the board of directors. And the main way of doing that is term limits. And what having a term limit does is it removes a lot of the stigma that comes with being asked to leave the board of directors, since there's a natural expiry date. Now, typically you can also renew a director. If the term is up, the person is still just as great as they were at the beginning. You can see them being just as productive for you for the next 3 years. You may bring the person back, but in general, you want there to be a renewal mechanism through the way that the terms are offered. While directors are on a board, it is their responsibility, among all other responsibilities, to also be working to renew the board, which means they themselves need to be networking and thinking about who's going to be coming onto the board in the future as the board grows, as the company grows, as the needs of the company and its governance structure change. From time to time, and I would say typically it's done yearly, the board does a self-assessment to identify its own weaknesses and skill gaps, and that typically serves as the main basis for the new nominees and the types of skills specifically and experience those nominees will have to potentially bring onto the board. And in terms of very short-term board evolution, where you're not really talking about changing the people or longer timescales, but just how do you get better from one board meeting to the next, you typically want to have one director who's very strong on the board, who can actually be the source of feedback to other directors who may not be as strong. and in terms of how those directors' engagement on the board and preparation and follow-through could potentially get better as time moves on. I would recommend that that not be the CEO, because the board has the role of being the oversight for the CEO, and even with power to hire and fire. You don't want to make the CEO's job be the one to go and provide performance feedback to directors. So one of the non-executive directors typically needs to be appointed to look after providing individual performance feedback to other directors. Now I'll talk about a stage of development perspective of how these critical board skills tend to change and evolve. So when you're first a concept company, you typically only have one director. It's the founder, the minimum that's required for incorporation. And at that point, the key skills are, business formation, friends and family funding, what are we doing for early customer and technical discovery. Page forward a bit, and we would be at what we normally term seed or a startup stage. At that point, it's typical that there's a 3-person board, one founder, one outside investor, one independent, who typically is a domain expert in the domain of the business. And at that point, it's about recruiting new key hires. It's about recruiting partners and collaborators. It's developing the technology to a point of commercial readiness. It's setting up basic operating systems for the business, going out and attracting arm's length funding, typically from angels or VCs, developing ecosystem relationships, and things like that. Now, page forward a little further to a growth stage business, which is typically one that now has meaningful revenues, predictive revenues, and is starting to have a more and more predictable ramp of growth. At that point, typically it's a 5-person board, 2 founders, 2 investors, and 1 independent in the nominal case. And at that point, it's all about commercialization, operationalizing know-how, meaning the business is trying to become bigger than just the founding team or a few critical early hires. It's about taking key know-how and capabilities and embedding that in the operating processes and infrastructure of the business. You start getting into more sophisticated financial issues, sometimes around working capital management, and often internationalization, either on the demand or the supply side of the business. It becomes a boardroom issue. And then late expansion is the phase typically in the run-up to an exit scenario, be it an acquisition, be it an IPO. At that point, typically the board is larger, and the main shift from the stage before it is you typically have a few more independents on the board at that point. And then there's a lot of emphasis, not unexpectedly, on financial measures. Do we have the right accounting procedures? Do we have the right controls and systems in place so that when we go public or when we get acquired, that our performance is likely to be viewed similarly by those who have potentially owned the business at that point in time as the way we have been viewing the business up until this point. I'll now just go through a different perspective of how board work and the key skills evolves, but I'll just do it by functions. And let me talk about early on in sales, you don't yet typically even have a product to sell. So selling is all about customer discovery. We think we've got an idea for a product. We think we know what customers would want this. And now it's about honing in and iterating towards what will real paying customers buy. And as time goes on, you've figured those sorts of things out. Now you've got a product, and it's about how do we make the value proposition even better? How do we make the product stickier? How do we increase the distinction of our competitive differentiation, increase the distance between us and our nearest competitors? And then at growth, your sales issues are all about how do we step on the gas and make this thing go even faster. We've figured out the winning formula, both for the product and the selling formula, and now it's how do we drive that thing higher and higher. And not unexpectedly, you're also getting into increasing issues around predictability of revenue and predictability of revenue growth at that point, because largely that the value that others will associate with the business at that point is linked to how well the business is able to plan a trajectory and largely hit it. Now, on the accounting side, to give you a sense of how life changes in terms of financial oversight on the board, at the very earliest stages of the business, you're managing by bank statements. It's what cash do we have, how fast it's going out, when's it coming in, and that's your principal tool. When you get to the startup stage in a typical profile, there's a part-time bookkeeper, so you're getting some semblance of a monthly income statement and balance sheet. Your concerns at the board are often, do those things provide a reasonably accurate portrayal of the business at an operating level? Are we getting our tax returns done on time? Are the source deductions that we need to be being done? And move forward further in time, in the growth stage, typically at that point, you do have at least a part-time and more often a full-time CFO. You're getting towards audited or at least pretty high-quality engagement reviewed financial statements. The company does have annual forecasts, not just of revenue, but all budgetary expenses that have predictive value. And you're spending more and more of your time at that point understanding the variances in outcomes versus what was planned in the time period running up to that as the basis for further optimizing the business. On the legal side, similarly to sales and accounting, the issues change dramatically as the company develops. Right on the launch pad, the legal issues are all about IP very often. What rights do we have? What rights can we secure? What are our filing deadlines? What do we have clean of chain of title, even on things as simple as our employer, employee, and contractor IP assignment clauses, and waiver of moral rights. And then the proper assignment of licenses, and even in something as simple as open source software, do we understand what the inbound licensing rights are and what the recommitment terms are, let alone more physically significant technologies. So those are the kinds of things at the board level that often you're worrying about legally early on. Now, at the startup stage, often you're spending a lot of time making sure you're doing your equity grants correct, or you're doing your equity grants correctly if it's employee stock option plan or something like that. You need to make sure that you've got the right paperwork. Nothing will slow down a future financing, like not being able to get to a clean cap table with who actually owns equity and equity rights now. You need to make sure you've got a complete minute book for the corporation, and the directors need to spend time understanding the essential terms of all material contracts. Certainly that's financing agreements, but that can be a lot of other agreements depending on the nature of the business and the partnerships that are in place. And then at the growth stage, it's about records management, compliance, risk management, litigation, whether it's real or threatened, on the theory that growing trees catch more wind, and there are increasing issues that the board needs to be aware of of how legal issues can come out of the woodwork for successful companies. So I'm going to just run through a menu of high-impact board practices. Some of these things have been popularized to a degree in the mainstream media. Some of these things are more some of my private playbook for how to do this. It changes quite a bit by stage of development, and I won't talk about these things in tremendous depth, but just to give you an example that there are terms and techniques that can be used and things to be aware of when the time is needed in your business. At the seed and the startup stage, the basic mindset needs to be that, everybody involved with the business, including the board, is incredibly enthusiastic about the potential of the business. There needs to be a shared recognition at the same time that by virtue of how young the business is, that many of the things that it's doing, or at least the particular approach that it's taking, is likely wrong by at least degrees. So the main challenge on the board at the earliest stage is how do we decrease our degree of wrongness most quickly? To put 2 or 3 negatives in the same sentence, but it's basically how fast can we iterate from the start where we are to something that's a much more resounding formula for the product, the process, the embedded services, all of those sorts of things. And so there's a class of techniques that you can use in the boardroom for the way that you try to at times open people's thinking up during discussion, and at times how you try to force convergence of thinking among a group of people to be able to make sure that the business is not prematurely locking in on suboptimal ideas or approaches, and to give the business the best opportunity to be moving as quickly towards the best solutions and approaches. As you get into the growth stage for the business, one of the really powerful tools for the functioning of the board is executive sessions. And this is where the board members who are not part of management meet after the full board meeting is done to talk about how the board meeting went. And they can talk about the information that was provided in advance in the meeting. They can talk about the performance and conduct of management. They can talk about the performance of the board. But it creates a regular forum for the board to, the non-executive board members to be able to talk with each other about how they're really feeling about how the company and management is doing. And simply having that opening and opportunity helps get small issues on the table early while the remediation is relatively manageable, and keeps those little issues from developing into much bigger things. And then as you get later on, you actually start thinking about governance as its own process, and the same types of continuous improvement techniques that you would use in a development environment or a manufacturing environment become as applicable to the process of governance. You're doing things like that, and even thinking about how do we specifically get new directors on board and up to speed. If it takes 2 or 3 meetings for a new director to figure out what's going on, that's an awful lot of lost opportunity, whereas if you have a very crisp onboarding and training process for new directors so that they can be largely productive much faster, that's a great advantage for everyone. A number of editorial comments that I'm going to run through in a very rapid fashion. There is no shortcut as a director for doing a lot of reading and networking in order to bring an informed viewpoint to the boardroom. Sometimes you'll have somebody who is just such a domain expert or such a rock star that they can do it without that time outside the boardroom in order to be sufficiently prepared for the boardroom. But those cases are exceptionally rare. And as a general guideline, the people who are going to do this well for you and for your businesses are people who can and will spend that time outside of the boardroom. I would say that the speed and dexterity of the board is generally better if you can keep it a little smaller rather than a little larger. It's just easier to get to consensus. And even on things as simple as getting calendar syncs to be able to set board meeting times, if you're working with a marginally smaller group of people, it just makes life a lot easier when you're running your board. I would say that in early and growth stage companies, you want to be meeting 8 times per year. If you're meeting less frequently than that, typically too many things have changed by the time you get to the next board meeting and people are overwhelmed or there's just too much to talk about. At the same time, if you try to meet a lot more frequently than 8 times per year, just the overhead of getting the meetings organized can start becoming overwhelming. So I would say that the optimal point, generally it's between about 8 and 12 meetings a year. I'm a fan of 8, but you want to make sure that the board is meeting regularly. And you want to make sure that whatever else gets talked about in the board meetings, that you're spending some time talking specifically about what's keeping the most senior management of the company awake at night. These are things that sometimes do not exactly fall into the categorization of the other things that get talked about in the headings of a board package. And you want to make sure that there's ample time so that the board can be on the same wavelength with what's worrying the CEO, and in larger companies, the CFO the most. First and foremost, so the board can help with that, but also so that the board can be then thinking about those things fully after the meeting to be able to provide as much input as possible on those things. Good directors are busy people. Don't send them a board reading package 2 hours before the meeting and expect them to have read it. You want to be thinking about sending board reading packages at least 48 hours in advance, and more typically 72 hours. When you're making proposals to a board, some people want to simply make a recommendation from management and hope that the board will adopt it. Other people at the opposite extreme will basically throw open an issue in a fairly raw form to the board in a completely open-ended fashion and say, okay, what should we do about it? So in effect, management is delegating the decision to the board. We're trying to do so. What is most useful, I find, is when management comes forward to the board with a specific recommendation, or at least a narrow range of a solution space that they think is feasible. And by doing that, it leaves room for some director input. It leaves room for a range of opinions and options to come out that may greatly transform people's thinking. But it doesn't reach the point where it's so open-ended that people are just frustrated that they can't get to convergence or get to a decision in a timely fashion. So you want to think about putting forward a recommendation and a range around that recommendation that makes sense to management. And when you do it that way, typically you'll be able to get the best input back from the board. At each board meeting, you want to take some time to talk about the quality of the information that went out beforehand, the agenda, how the time was allocated, how the time was managed during the meeting. And you want to make it the ongoing responsibility of all directors to propose themselves specific improvements for the next meetings. It always takes a while for a given group of people in a given context to really find their stride and their rhythm together. But if you don't take the time to ask the questions of even some of these basic things, these things get forgotten. The board is not functioning as well as it could or should be, and the business then is not functioning as well as it could or should. Similar to the board providing feedback to management, there also needs to be an opportunity for management to provide feedback to the board. And so the board needs to actively solicit the input periodically from management of where management has gotten the most help from the board and where management has gotten the most frustration from the board. So the board understands how its customer or one of its main customers is seeing its work. As a general rule, you want to use 75% of your time in the boardroom looking forward and about 25% looking back. Typically looking back is on recent operational performance and key performance indicators as well as financials. And the forward time is talking about strategy, the marketplace, how it's developing partnerships, major new hires, things like that. The board, especially in the early stage setting when the companies are not yet at self-sustaining cash flow, you have to know what the financial runway is at all times. You've got to be proactive raising funds. And directors will have the highest value in that setting for all concerned when they know all manner of how to access funding, not just additional dilutive equity funding, but also knowing what non-dilutive sources of fundings may be available to help bring as much value as possible to the business. You generally want to have the board members rotate who's going to take the hard stand on major issues so that people don't fall into a lazy pattern of expecting a single individual to always be the one who's going to bring forward the sober second thought. It's important that that burden be shared. And one director needs to be responsible for the CEO's performance evaluation. This is something that boards love to forget to do. And when left for too long, it becomes a pretty significant issue for all concerned. So now all directors will contribute to the CEO's performance evaluation, but it's important that one director be responsible for ringleading the process and making sure it happens. And then know what's in the articles of incorporation, the bylaws, and the shareholders' agreement for the businesses that you're working with. The number of times that I'm in board meetings, and sometimes when I'm an observer, and discussion is going on an issue where the board is assuming it has an authority that in fact it doesn't, or management has an authority that it doesn't on its own. There's some just basic landscape issues to understand. So whether you're going to be on a board or whether you are building a board, you need to make sure that people who are in that role understand what's in those governing documents, because that has great influence on the correct functioning and the sustainable functioning of those groups for the better interests of the corporation. And last point on this is that if you've got any debt in the business's capital structure, which is a fancy way of saying if you've got loans or lending agreements, especially if it's structured finance where there are covenants, you want to make sure that you have a tabulated list of those in the board book each meeting so that people can understand as we deliberate certain moves that may have impacts for our financial performance, when do we start approaching the zone of concern where we need to be particularly aware of where we may get offside with those things. This again is one of those things, it's something that gets forgotten by people, especially as time goes on. It's very simple to just make that a regular part of the board package. It's a lot of work to create it in the first place, but not very much to just repeat it from package to package. But this also is something simple that can help keep everybody on side. And then the last section of the prepared remarks this evening is regarding board of directors compensation. So the question that I'm addressing here first off is, what are the norms for compensation for independent directors? And independent in this case means it's a director who's not a founder, the director is not part of executive management, and the director is typically not even one of the investors. So this would typically be an industry expert that has been brought in for their domain knowledge, and but because they're not an investor and they're not management, it's necessary to compensate this person for the risk and the time that they're going to take in that role. So very early on, at the angel and pre-angel level, typically the compensation would be stock options for anywhere between about 0.5% and 1% of the company. That assumes a 3-year term and 3-year vesting. And some of the other things that I described, such as 8 board meetings a year and presuming fairly active engagement and follow-up and offline reading and things like that. But in that sort of case with a very early stage business, that would be the typical range from about 0.5% to 1% in terms of stock options that would go to an independent director. As time goes on, as the business grows, as the business gets less risky, and as the business gets more and more valuable, the proportion of equity goes down along the lines of what you see on the graph. There's no hard science to exactly how to do this. It's always a matter of negotiation. There are industry-specific customs. But typically, later on, you're looking at a high end that would be 0.5%, and more typically a 1/4 or even 1/3%. And then when you've got companies that are right on the doorstep of either going public or a substantial liquidity event, if you're bringing on new directors at that point, the equity entitlements get proportionally less again. But that gives you a sense of the kind of ranges that people typically are being compensated as independent directors when they're asked to sit on arm's length boards. And then the other aspect of director compensation, so this assumes that there's no cash in the director compensation. This is purely stock-based or equity rights-based compensation. And normally it's done with 3 or 4 year vesting. It's best typically if the vesting term matches the term limit. So if you're on a 3-year term limit, my recommendation is have 3-year vesting. Normally you have a 1-year cliff for new independent directors, meaning they don't gain any of the equity rights until the first year has gone by. That allows everybody a period of mutual assessment to make sure it's the right fit, the right chemistry in the boardroom. However, if it's an incumbent director and that issue isn't really there, then typically there's no cliff. Monthly to quarterly vesting after the cliff. And then a post-service exercise term of normally is a year, meaning for a year after the director has stepped down, they still have the rights to exercise the vested options before they expire. And the last thing about the director equity rights for independent directors is that you normally have full acceleration upon acquisition. And meaning that there's full vesting acceleration. And the reason for that is that the directors have a hell of a lot of work to do in the run-up to an acquisition. The fiduciary responsibilities at that point are very high. And normally the way to preload that they'll be compensated for at least some of the time that they're going to put in at that point, and the fiduciary risk that they're under when the value for the business is going to be permanently crystallized that way, is that there's simply full vest or full acceleration of their options at that point. Last slide is resources and further reading. I recommend all of these resources very, very highly. The long-form Bible of Directors' Duties in Canada is Barry Reiter's book. A very current book, it's a US book, but a very current book on startup and growth stage governance is one that's written by Brad Feld and his partner. And if the matters that we touched on briefly at the beginning around board of advisors and how to compose one of those and how to think about and operate one of those, if you're needing to get a lot further into that subject, Steve Blank in his book, The 4 Steps to the Epiphany, does a dynamite job of talking about how to really make a board of advisors work different and apart from a board of directors. If you're at all like me, you tend to think of your best questions just after you've gotten in the car to drive home. So please do reach out to me at those coordinates if I can be of any help related to anything that we've talked about here tonight. We will have some time for some Q&A, and I'm not rushing out of here afterwards, so I'll be able to talk to people one-on-one. But I know people have places they've got to get to, so do reach out to me by email if I can be of any help as you build and grow your business. And with that, that concludes my remarks for tonight. Thank you so much for your time this evening.
We do have time for about one question before we have to end. Go ahead.
A lot of pressure. Compensation for board of advisors, equity compensation, is that something that you would consider? And when you say pick one person to join your board of directors, who's a domain expert, and if it's a tech company that's operating in a specific field, like mining or entertainment, do you pick an entertainment or mining director, or do you pick a former tech director in terms of experience and domain expertise?
Okay, so two questions. The first one on advisor compensation. So yes, advisors, especially if it's a more formally run advisory board, meaning that there are regular meetings, there is some expectation of prep and feedback. You know, it's not just the ad hoc coffee at Starbucks once every few months. Typically, there is compensation, and normally it's done at about half to a quarter of the rate that is done for a fiduciary director. Because the advisor is not under the same time commitment and not under the same liability, that's the main reason why it's compensated less, even though they're still providing a valuable service to the company that does merit compensation. When it comes to domain expertise, generally people favor those who have expertise in the vertical, in the demand space that the company is selling into. But I have seen exceptions where the company is bringing a radical new technology to a new application space, and people who understand the complexity of that new technology from a different domain may in fact be more valuable for helping to corral the main issues that the company is dealing with. And I'll give you an example, specifically in something like nanotech, or I've seen it in certain types of MEMS, where the application knowledge down the line isn't as important early on in a very, very technically involved deep science type of business as getting people who have extensible experience with the same types of technology drivers. So there is that sort of exception case, but in general, the vast majority of cases when people are seeking an independent director, it's people who have recent experience and a lot of credibility in the demand domain that the company is planning to sell into or partner into. Okay. Yes?
Thank you for the very informative session.
Thank you
so much. I have two questions. The first one, when the directors have the financial responsibilities according to the current regulation. And the second question, if there is some contradiction between directors, so how it can be resolved and it should be actually presented in shareholder agreement. I mean, regarding the casting, voting, right of chairman, something like that, what they know like way to overcome the contradiction, difference in opinion of directors.
Yes. Let me, so I'll deal with the second question first about how to deal with conflicts and differences of opinion among the directors. Normally, that is the moment where an independent director on the board needs to shine, because they are the one that is least encumbered by other relationships in the business, such as being part of management or being a founder. And it is normally best if that individual is willing and capable to help mediate some of the task level disputes that can arise. Now, on some of the larger structural issues, such as who's the chairman of the board, or if there's an even number of directors, who has the deciding vote if it's a split vote, on some issues like that, normally those things are worked out in advance as part of the shareholders agreement or the investment agreement, so that those aren't left to be on-the-fly matters to try and figure out under difficult circumstances. It's far better when cooler heads are prevailing in advance if those types of issues, at least some of those major structural issues, can be worked out that way. Your first question, I have to apologize. I missed one or two of the key words in that, and I didn't fully understand the question. So if you could repeat your first question, please.
Yeah, I mean, there is board of directors, and directors, it's a limited company, right, corporation. So, but nevertheless, they have some financial responsibilities for the business performance, eventual business performance. I mean, maybe some problem with environment issue or criminal and something. So my question is, what the specific, like financial cases when directors personally responsible by, like themselves for the company activities?
Well, it's a very broad area around what the extent of director liability can be under different conditions, problematic conditions for the company. So I'm not even going to venture a simple answer. But let me give you one example that's a relatively clear-cut one that often companies early on, before they've got sufficient revenues and cash flow, will at least contemplate, which is that the directors can be responsible for the unpaid wages of staff, at least up to a certain limit. And so, especially if a company is getting close to running out of money, things are taking longer than expected with the next fundraising round, that's an almost routine situation that as an early stage company director, you may be facing personal liability for the unpaid wages of workers if those workers continue to work and accrue wage obligations while the company hopefully finishes off closing a financing round. So it really does, it's not something that is a distant issue, especially in the startup space. Even something as specific as that is something that is a very prevalent concern for directors.
And unpaid tax as well.
Among other things, that's only the starting point, but it just gives the people in the room and on the webcast a sense of one typical example of where personal liability for directors can develop.
Thank you.
We are out of time, but thank you very much, David. You will be around for any other questions that people have. Yes. Thank you, everyone, for joining us.
Thank you very much, everyone.